Happy Sunday, everybody. Thank you for joining us on this weekend webinar. We appreciate it. Good morning, Jim.
Good morning. Good morning. Okay, our goal is to get to Thursday where the short trap was set, and then show how that gave good probability of the short covering rally on Thursday. And finally, we will end up and say what the short covering rally on Friday. And then finally, we will talk about the potential for the coming week as information that we gained from what we saw on Friday. One of the things that is so important, and if you've been with me or heard me very often, one of the things that I shy away from more than anything else is my trading profitability or loss or anything else. That's not what it's about. It's about you. But I'm going to make an exception today, and I'm going to show you or tell you that if this is, I'm going to be 85 this summer. Of all my years in trading, this is the best start to a year that I've ever had. Now, I'm going to walk you through the process and what got me there. Now, as you know, with traders, we don't know how much is skill and how much is luck and how much is a combination of that. But the difference of what I do versus what so many other people do. So many other people are technically oriented, and I'm not. If you take the distinction of what I do and what you're going to see when we talk about the short trap on Thursday, is that my focus is on behavior, on the behavior of the people that we are participating with and against. The next review is we talk, and I can never remember exactly what the right term is, the dispersion chart that starts off with the innovator, early adopter, early majority, late majority, laggard. That is kind of a way to look at what I'm talking about is behavior. So with that in mind, let's get a start. If you look at the bar chart in front of us, and if you've read, any of the weekend reports, all across the top here, the market has, of course, been up for some period of time, but all across the top is activity of the laggard buyers. The market's been up for a long period of time. They finally figured it out. When you see the behavior where they are buying exacting trend lines, that is an indication of technically oriented laggard traders. Smarter money, stronger money does not buy at exacting references. So the laggards got the market too long. Then you got a liquidating break, took this all back. The laggards came back in again. They did the same thing, took it all back. The laggards came back in again. They're buying every break, took it all back. They did it again, took it all back. They finally did it again. One of the things that I have observed, when you have a major support line, which would be right across here, this was a downward spike, or I'm sorry, downward gap and rejection. 1, 2, 3. It is often the third time before that is taken out. And remember, I refer to that concept as the semi-permeable membrane. Every time it gets poked, it gets weaker. It's like taking a balloon with a pencil, and every time you touch it, it weakens the balloon a little bit. So that's where we are. So we got the downside. We got the downside breakout. This was the laggard traders. Finally, now, but the important thing is these laggard traders were being met by innovative sellers. The innovative seller is another way to say longer term. That doesn't necessarily mean investment managers, but longer term traders, longer term investors, more serious money was selling into every rally up here. Now the market finally gives way. And this is the third time down. And I say quite often, it's the third time that you really get a serious break in the market. Notice that there's a low, a support low down here. It was visited twice, so it's not really a good low. Markets very often go to very visual levels. And that's exactly what this market did. So you get this break, you get the downside breakout. And now what we're going to do is we're going to replay. This is Thursday right here. This is the short trap. But what I want you to think about here before we go into this is remember, instead of looking at prices and technical indicators, we are looking at market behavior. To look at market behavior, we call that market generated information. So we've had laggard buyers up here for some period of time. Then we started to get that was met by innovative sellers. And then you started to get the early adopters, early majority, and what you got was the late majority in here. You were looking on Thursday. When we look at Thursday, you are looking at the late majority, or the laggard sellers. Okay, Jen, let's replay Thursday and let's take a look at what I'm talking about when I'm saying that I take my information from market generated information or from behavioral aspects in the market. Okay?
Okay, can you see my screen?
Yes, I can.
Okay.
Okay, so as we're coming into Thursday, the first thing you see is that the market is somewhat balanced. The overnight, there's the 5,600 level. There's the overnight low from Wednesday. So overnight inventory is long. We know that when overnight inventory is long, there's a very high probability of a liquidation break. Now, you also know that about 20%, 15, 20% of the time, when you don't get that liquidation break or counter auction, that is an indication of a different tone to the market. So on Thursday, you're going to see the liquidation break. You're going to see something totally different on Friday during the short covering move, but we'll play that out as we go. So let's replay Thursday. My focus is going to be using market generated information to understand what my competition is doing. Okay, and we're going to let's start off at about 15 times normal speed. Okay, so look at the early morning high, just below the 5,600 level. So we opened within the previous day's range. Overnight inventory was long. The odds are you get a counter auction. So you're getting that counter auction relative to overnight inventory. You're within the overnight range, within the overnight range. So there's nothing going on here. But remember, the trend has turned down. We saw that. And what I do, I try and trade with the trend. There's your counter auction to overnight inventory. Look at the exactness of the A period high coming from the 5,600 level. Who do you think sells at exact references? That is not the behavior of long-term traders. Long-term traders do not act at exacting levels.
Jim, just real
Yes.
quick here, because we have several people with the same question. It wasn't the overnight inventory short, mostly short?
Oh, I'm sorry. Yes. Yes, I'm sorry.
Jim often, sorry, I didn't catch that and correct him. Jim often says the other word, right means left and left means right sometimes. So
I'm sorry.
he
No,
he inverts things. So
I'm sorry. That was absolutely totally wrong. Forget that. So we're trading within the overnight range. We're trading within Wednesday's range. Okay, continue to play. Thank you very much. But notice the exactness of the 5,600 level. So we've looked below the overnight low. Okay, go up to about 30 times normal speed. Okay, notice there's no excess on the low. Remember also, when you open within the previous day's range and remain within that previous day's range, stop for 1 second. When you open within the previous day's range, the odds are you're going to get chop or rotation. Chop is one of the most expensive traps that you fall into as trading, as traders. It's expensive from a dollars and cents point of view, and it's expensive from an emotional standpoint. It robs you when you get caught up in this chop. It robs you of both emotional capital as well as financial capital. And I believe that emotional capital is more important than financial capital. Financial capital, sometimes we can recoup. Once you use up your emotional capital throughout the day, you're pretty well on a disaster course. Okay, continue to play, please. So remember early on, coming from the exact level. Okay, now stop right here. Notice, first we talked about the A period high being exactly at 5,600. That's behavior. Look at the B period high, a tick below the settle. One more time. When you see that, that is not the action of longer term money. That is the behavioral characteristic of shorter term traders. So early on, shorter term traders got too short. They showed it exactly at 5,600. They got too short, and then you got a short covering rally. Notice there's no excess on the AB low. Okay, continue to play, please. And play about 30 times normal speed.
did you say 20 times, Jim?
30.
Oh, okay. We were on 30. Okay.
Oh, okay. Okay, stop for 1 second. Notice the C period high look at the green dot on the left, okay, and the C period high. So the C period high is just a tick below the opening. So the B period high, the original A period high, the C period high, those are all behavioral characteristics of shorter term traders. Continue to play, please. Stop one more time. Okay, notice the white line indicates half back for the daily range. The little white line above that is half back for the current 30-minute period. Okay, continue to play. That's going to be relevant. Remember, there's no excess on the low. Okay, stop for a second. Notice the D period high is a tick below half back from C period. The B period high is a tick below the settle. Those are both behavioral characteristics of shorter term traders. So when you see the market going down on a day like Thursday, if you don't understand this kind of information, this is what we call market generated information. If you don't understand this information, you get caught up in price, you get caught up in technical indicators, and you can lose a total perspective of what is going on. What is going on here is the shorter term traders are getting themselves short. Longer term, smarter money does not sell from exacting references. And they may occasionally, but it's very, very rare. Continue to play, please. Okay, D period went up and tagged the half back exactly. Remember, we said there was no excess on the B period low early on. Excess meaning, the low odds that that's a good low. So look at that, the D period low right now is exactly at the overnight low, or tick within a tick. Okay, now let's stop again. Let's read this whole for a second, please. Okay, let's just review. This is so many times traders are focused on footprint, or they're focused on bid ask, they're focused on some technical indicator, and they lose the bigger perspective of what's going on. Remember, we started off showing how the laggard buyers put a high in on the market. It took several weeks that the market moved sideways, but we then got a downside breakout. So what stopped the market from going any higher? Innovative sellers. As the market started to break, you get the innovative sellers, then you get the next sellers are the early adopters, followed by the early majority, the late majority, and finally the laggards. So just keep in mind, let me go back. I'm going to go back and take one fast look at the bar chart. Okay.
Okay, let me give you the screen.
Yes, please. I'm sorry.
Okay. There you go.
Okay. Laggard buyers being met by innovative sellers. That took place for several weeks. Then the market starts down. You get the innovative sellers. You start to get the early adopters, early majority, late majority, and now I think what you're seeing late last week, you're seeing the laggards. Okay. And remember, we were looking across here. This is their downside breakout. So the trend is down. The trend is down. Okay. Let's go back to your, Jim, we get time for a couple of questions before we go back to your thing, if there are any.
There are some, but not exactly related to what you've gone over. So I would
Okay.
wait for
All right.
later.
Let's go ahead. Back to yours. Replay.
Okay. Okay. Can you see my screen?
I certainly can.
Okay.
Okay. So now, remember, we have, if you take a look, the 311 low, there's no excess on that 311 low. Okay. Now keep in mind, trends down, shorter term traders, the laggards, they've all finally figured out. Remember how far this market's down. This market is down. It's approaching 10% from the high. It's approaching to be 10% down from the high. The laggard sellers have finally figured out that the market's trading lower. Keep that in mind. Okay, continue to play, please, Jim. And remember, as you do this, the difference between what most of you do and what I do. Most of you are looking at technical indicators. I am looking at and reading the behavioral characteristics of my competition, who I'm competing against. And remember, there's no excess on that 311 low. See how stretched out this market's getting? When markets get stretched out like this, that is usually a sign of emotional selling. Emotional selling is very dangerous because you tend to get, these are the markets that give you a tremendous amount of whipsaw. So now we have, let's stop 1 second. The 311 low on your far left has no excess. Thursday's low, the 13, has no excess. So you now have your two lowest lows with no excess, excess being single prints. The odds, and remember, my focus is not on price. My focus is on more on odds. And the odds are that we're going to take those out. One low with no excess, you know, the good odds to take it back, but they're not high odds. Two lows with no excess greatly increase the odds that this is going to be taken out. In other words, what does this mean? This means that there was no aggressive sell. There may have been short covering, but there was no real aggressive buying, or, you know, they had to wait to exact levels. Okay, continue to play, please.
We do have some questions relevant to what's happening here or what we're observing here, Jim. So do you want to take those right now?
Sure.
Okay. Due to the longer time frame being bearish or a downtrend, would you advise to best look for shorting opportunities? For example, go with the downtrend unless the market presented a long opportunity due to a structure change.
Okay. There's multiple answers to that question. From the time the market was showing that we had the highs up there, and I said there were laggard buyers met with innovative sellers. My mode of trading was selling rallies, taking profit on breaks. So the trend is down. What the trend is down, What I want to do is I want to sell rallies and I want to take profits on breaks. Okay, so that puts us in that's a simplified statement. However, you have to put that in a better perspective because we're short-term traders. Remember, I'm a day time frame trader. So markets can get extensively long or excessively long or excessively short. And as short-term traders, we have to totally constantly be aware of that. So yes, my trading has been oriented to the short side, but I'm also constantly looking very closely at what is happening in the day time frame. Okay, so now what I'm talking about here, this is the whole purpose here is showing you, yes, did everybody finally figure out the market was going down? Yeah, but they're a little late. But now you've got the laggards selling into it. So the answer to your question is there's not a simple answer to your question. Overall strategy, yes. I want to sell rallies and take profits on breaks. And I'm doing most of my trading from the short side, but I'm a short-term trader. I'm a realist, and I know that markets get too short and too long. So you have to look at a deeper concept, a deeper view of the market than just a simple answer to your question. Okay, what else?
Okay, and then another question is, as soon as the D period tagged the half back of C period, would that have been a legitimate opportunity to short down towards yesterday low?
Okay.
I'll argue that they probably mean like any of these references, that we had observed in the beginning. Um, would any of
Okay.
those,
That is
also
a
have been legitimate short
that is an
entries?
absolutely fantastic question, and it's multiple answers to that question. I do not short at those levels. And I do not short at those levels because I think there's good odds that we're coming back through them. Now, that's me. If you are a little shorter term trader and you've got good discipline and I may look for 2 to 3 trades a day. If you're doing more than that, that is an ideal place to short. And if it doesn't work immediately, you're out. So that's where you've got your stop immediately. So like I say, it depends on you, depends on your trading, and it depends on if you read the market for what it is. So there's no direct answer to the question. I do not. I do not do that short because I think there's high odds we're coming back through it. Somebody else may do that knowing that they have very little risk because it either works or it doesn't work. We call those trades anchors. We call those references anchors. And anchors are they're informational. They're artificial, they're psychological, artificial references that traders have decided are important. They've decided that half back was important. They've decided that the 5,600 level was important, or the settle was important. And when I see people using those exacting levels, that is usually an indication to me that it's shorter term, weaker hands traders. Okay, Jen, let's continue to play.
Okay.
Now remember, we said the 2 lowest lows, no excess, good odds, we're going to take them out. Really good odds, we're going to take them out. But see, shorter term traders, they're buying at mechanical levels, right? They're going to come as close to that reference from the 11th as they can get. That's how some people trade. And if you know what's going on, that's okay. I look at it and when I see that, I think there's a good chance we're going to take it out. But again, it depends on how quick you are, how mentally quick you are, and if you can adapt. Okay. So now it's even worse, right? Because the low is even worse when you put the low from the 11th and the 13th, even worse. But look at short-term traders, we're buying at that exacting level. This makes it very difficult for traders. You have to know who you are and what you're doing in order to keep perspective. Otherwise, you're going to get whipsawed all day long. Okay, so now we've taken that out. Now stop again. Where is the G period high? The G period high is a tick below the overnight low. Another behavioral characteristic. So when I see that, I know that the weak hand sellers, because they're selling at exact references, one tick below the overnight low. That is not the behavior of longer term sellers. That is the behavior of weaker hands, laggard, short term sellers. Now, this gets very confusing. This is not easy. This is not easy at all. And that's why most traders give up on what I do, because it's too complicated. Most traders don't make money. Okay, continue. Now, so we've got multiple. E period is exactly at half back. G period is a tick below the overnight low. We've got the A period and the D period, what up above.
Jim, I'll just mention the E is only at the half back of the range of the day because of the extension that happened in G. So
Oh,
I
I'm
don't know
sorry.
that you would.
I'm sorry. I'm sorry. So just the G period. I'm sorry. Thank you.
Yeah,
So the G
yeah, and you
period.
still have the D at the half back of C
Yes.
period
Yeah.
range there. So,
Okay. Continue to play. Okay, we're down to, we're down in correction and all the news. Oh, it's down 10%. It's an official correction now. They're really stretching it out, right? Really getting it short. Everybody knows now, boy. Okay, now keep in mind, stop for a second. So many times, what happens to you, you get caught up in what is happening today, and you forget about the bigger picture. I deliberately started by showing you where the market was at the highs and the laggard buying at the highs, how they got in trouble. Now, here the market is off 10%, and finally, the laggard sellers have figured out the market's going lower. Very late to the party. That's where the opportunities come up. Okay, continue to play, please. You're only going to understand what's going on here if you can get your head inside of the laggard traders, inside how excited they are. And boy, they all know the market's going lower. Okay, stop one more second. Now I'm going to introduce another observation that I have made throughout my trading history. It's what I call tone for a day. Market gets a tone for a particular day, and that's all short-term traders see. They don't see what I see. They don't see those mechanical weak highs. They're caught up in the tone for the day, and the tone for the day, they're selling every rally. They're looking for every chance to sell a rally. Okay, continue to play. That tone for the day, if you can keep that in the back of your head, a lot of times that will help you separate what's going on in today's time frame versus what may be setting up for another time frame. Okay, So they've really figured it out now, right? And there it goes for the 5,000 level. Okay, take it up a little faster. Take it up to full speed for a while. But feel this, feel the tone for the day. Boy, short-term traders, they're excited. They know the market's going down. They're selling every little rally. This is where they're getting themselves in trouble going forward. The trap is being set. Look at the J period high. They sold it exactly at the H period high, right? As Jen's pointing out, the K period high, exactly at halfback. L period high, overnight lows. They're selling again at overnight low. Look how aggressive the selling is. And look at the L period low. Look how aggressive that selling is late in the day. Okay, market's closed. All right. Now, you have just seen the trap set for a huge short covering rally. Let's review this, and this is so tricky, and it wears on you. You see price going down all day long. All day long, you see price going down. Let's review, Jen. Where is the B period high? The B period high is what? A tick below the settle? Where's the D period high? To the D period high? Half back from C period. Those are mechanical references. Where is the L period high? It's a tick below the overnight low. Those who sells at those mechanical references? Those are short-term traders. Now, the question was asked, can you do that? Yes, you can sell it if you understand what others are doing. If you think that's a great sale there, because the market's going lower, you're in trouble. If you say you're going to sell there because you know what your competition is going to do now, and you know how to protect yourself, and you understand the bigger picture of what's going on, you can make that trade. The person that gets hurt is the person that they're caught up in the price going lower. They're caught up in the trend being down. They're caught up in all the news, that the market's down 10%. This is now official correction. They're caught up in all that. Now they're different. They're getting themselves in trouble. The references in this day told me that the odds were that the market was tremendously short. And this is what you see is the short trap developing. Price was down. Look how aggressively they were selling at the at the close. Look what happens right after the close. Okay. As hard as it is, this to me is one of the places that I find options are attractive. Because when I went home, I could buy some out of the money calls for the idea that we have a very cheap and way out of the money. Okay, so this is, you have just seen the short trap set up. Now we're going to replay Friday in a minute, but let's take some questions here, Jen.
Okay, Jim. Do you want me to give you the screen back and then I'll set up for Friday? You want it at Friday morning, right before the open?
Yeah.
Okay, so let me set that up. I'll give you the screen and we can do some questions. Okay, I've given you the screen.
Okay.
I have had some people ask about the primer, Jim. Do you want me to go over I guess I can go over it after you do some questions.
Okay. Well, let me just before Jen gives me the question, talk about the primer. Let me talk about, if you're, there's going to be some people are going to be really upset with what I'm going to say right now. If you are looking at uh, short-term charts, minute bar charts or 5-minute bar charts, you're not going to see what's in this market. The minimum, I think the minimum chart I think you should look at is a 30-minute chart. And you won't see the references I'm talking about. They're important references. I've looked at this over the years. This is what Stottlemyre started out with. I've tested it many times over the years. I did what everybody else did. I look at a 5-minute, I look at a 15-minute. Without a question, 30-minute provides the most important information that I can. Most traders are using, or at least a lot of traders are using, very short-term charts. And if you're profitable, that's fine, but I'm going to guess that you're not. Okay, now, if you are serious about really making a change in your trading, I'm going to give you the cheapest way to go about it. One, buy my new book, Markets and Momentum, How Profiling Gives Traders an Advantage. Markets and Momentum, How Profile Gives Traders an Advantage. My main point in here, there's several main points, but one point is that momentum is the leading indicator. Momentum is the leading indicator. The laggard indicator is market generated information. I understand that most people are momentum traders. What we do when we're talking about market generated information, we are putting context around momentum. You can go back to the early Greek philosophers, and the basic thing is there is no learning without context. Price is only an advertising mechanism. The majority of traders are trading price. The majority of systems and the majority of education is price-based. What we do is we put context around momentum. When I show you the mechanical highs and tell you what that means, and it probably suggestion that the market's getting too short because this is the behavioral characteristics. I'm looking at behavior. That is putting context around momentum. Now, to go forward, Markets and Momentum. I'm the author, but the second author is my son, Rob. Rob is a very, very wonderful writer. Basically, what happens in here, I've talked through all the things I've seen and observed over my almost 50 years of trading. Rob has been able to listen to that and put it back and present all the information that I have in this book. Now, you're not going to read it. It's not in a nice outline form. It's, A, B, C, D. Really being an expert at anything has to do with nuances. The book is full of nuances. And if you really, it takes time to absorb these nuances. It takes time to learn them and to observe them. But you have to get to the point where if you're going to distinguish yourself from anybody else, nuances make the difference. So you go through the book, and yes, it's an easy read. It's an easy read, but the absorption of what is there is not easy. It's an easy read, it's a fun read, but the absorption of what is there takes considerable time and thought in there. Now, that would be what, if you're really serious about starting trading or changing your trading, that's where I'd start. Then we have a primer coming up. And the primer, what's the date of the primer, Jen?
April 23rd through May 1st. So for
Okay.
those of you that are new, you can go to our website to get all the details if you want to read through everything thoroughly. But it's April 23rd through May 1st, so it's 8 days. And you can find it under our courses or under the sliding images on our homepage here. Those of you that are new, if you want to check out more content, you can go to our YouTube channel, public webinars up here. Sign up for our emails here if you would like to subscribe to our emails. But the primer information is featured up here at the top.
Okay, let me take a few. You can read it there if you're really that interested. But here's the important thing. The first 4 days of the primer are linear. You know, they teach you the market profile, how to keep the profile and the references and things like that. The next 4 days, we take the live market. So we really start to give you a chance to integrate some of these things we're talking, just like when we go through today and we talk about the short trap. Now, if you have really, really read the book first, you're going to get a lot more out of the primer. And to most people, this is going to be very difficult because you're so inundated with how you look at things, and you're probably short-term trading and courses you've taken. But the question you've got to ask yourself, if what you're doing has not been successful and has not been successful for a considerable period of time, take a look and think about a new approach. Okay, Jen, other questions, please.
Okay, so hold on, let me get my bearing on where. Okay, so somebody had asked earlier if the primer was only for people that are new to market profile. My answer to that question is yes, it's great for people that are new if you're trying to figure out if market profile is something that you want to utilize and learn more about. It's also great for people who have some knowledge and you want to make sure that you understand the concepts as intended by Jim, because I can't tell you how many times people have either learned from elsewhere or made assumptions about a lot of concepts that's not the way Jim would look at it. And then also for those of you that are experienced but want a really good review, and also it's kind of like a meter check on from where you were to where you are now in terms of your understanding, because you hear all of the questions that newer people or intermediate people may ask, and that's kind of that can be a gauge for you as well. But as we say, you know, with any athletes or anything else professional, you always go back to basics, and there's always some, you know, golden nuggets that you can take away. So for a really inexpensive price, we get a lot of people who are experienced traders but come back because they're just like, I want to hear what Jim's thoughts are on during the live market days, and also just to make sure that they're reviewing the basics, because it is easy to forget some things or to have them on the back burner rather than the forefront. And you do not need to have any market profile charts to join us for this course. There are no prerequisite requirements to join us for a primer. So, and everything is recorded, and you'll have access to materials for 3 months after the course finishes. So in case you live in a time zone for which you can't attend all of the webinars live, or you are somebody with a day job, completely understandable. You may not be able to join us live for every single webinar, but it's a good opportunity to join us for a primer because we don't do them that often. Okay, and the schedule is posted there in the details. You can see all the timings there. We even have class on a Saturday morning during that eight-day period. If you have any questions, by all means, you can contact us at the bottom of our website or at Jim Dalton Trading, or I'm happy to speak with you over the phone. Okay, Jim, let me give you charts back.
Okay.
And you can ask some questions, and then we can I'll finish the setup of Friday.
Okay.
There you go.
My last comment, if you're really serious, read the book and read the book thoroughly. There's a lot in there. And then the primer. That's your package to get started. But don't expect immediate results. You don't change behavior. You don't change behavior quickly. If you're starting, actually, the person that's starting fresh has a better chance than somebody that's coming in late because they're not satisfied with their trading, because unlearning is so challenging. Okay, other questions before we replay?
Along the lines of that too, just to interject, I just want to mention there's a lot of traders that may have some experience and they don't see what you're teaching on a deeper level. And I attribute that a lot of times just from a general sense to you don't know what you don't know. And I know that that's hard for some people to be upset with hearing that statement. Other people will that have that sneaking suspicion will understand that statement. But it's just something that I felt important to mention
And
on
people
a
using
general
1 and
basis.
5 minute charts, this is just so different to what they've been doing. It blows their mind. Okay. Anything else before we do the replay?
Yeah, well, there's several questions if you want to take some of those now. It's just that
Sure.
I'm multitasking trying to set up the
Okay.
thing
Okay.
and view questions. So let me get to some here. 1 second. Okay. Was lower value on Thursday a factor when thinking about how long it might take for the short covering rally to take place? As a short-term trader, I'm looking for intraday opportunities, and the short trap that Jim describes here took more than 1 day to develop.
No, it did, but the real development of the shorts came on Thursday. See, that was when the laggards finally figured out the markets. That was remember, you got the early adopter, the innovators, the early adopter, early majority, late majority, and the real thing was set up with the laggards. After all the time and how the market was down, the laggards finally figured out to the short side on Thursday. That was the real trade. Yes, it was getting short before that, but the real opportunity was being set up on Thursday.
Okay. Okay, since the high in February, if we looked at all of the intraday periods on the way down, are there no poor highs? Do they get revisited in the coming days or weeks? If poor lows exist, higher untested, I think you mean to say poor highs to this person. Were the 313 poor highs? They said, yeah, poor highs more significant due to the presence of laggards.
What I basically do when there are those poor highs and poor lows, sometimes the market gets away from them, and I don't really bring them back into my thinking until we get within striking distance, because what happens, so many times people over collect those references and they get themselves really messed up. Overall, I'm looking on a daily basis as a short-term daytime frame trader on a daily basis. I am focused on the trend, and then within the trend, I'm focusing on value. So for example, on Friday, value was lower. So what value was lower on the short-term basis on Friday. And if you sold every rally with value, you were in pretty good shape. But then you have to be able to say, okay, that's today, but you have to mentally shift and say, what's going on a bigger picture? That's nuance based, and that takes a lot of experience. And that's why it was so important for me to show you Thursday and how the final trap was set. And the market generated information was there. Those poor eyes were pretty good indications that the selling, the issue is who's selling it. Some people get all excited. A lot of people think, oh boy, we had longer term selling on Thursday. We didn't. We had laggard, weaker hands selling on Thursday. But if you listen to the TV, oh, it's 10%, it's an official correction. It's so easy to think, boy, we had longer term selling in there. But that really wasn't what was happening. It was the laggard sellers. Okay.
Okay, and I have several people that asked a somewhat similar question about your books. I began with reading markets and profile, first. Should I have started with markets and momentum first?
No, I would do mind over markets first. There's a lot of things that have changed in mind over market, but it really will give you a good idea. For example, and very few people, I don't know if I've ever had anybody that has realized the early importance of what is written in Mind Over Markets. Mind Over Markets is written from the point of view of how do you become a concert pianist. And it takes you through the 5 major steps of becoming an expert. You're a novice, you have a piano with white keys and black keys, white and black keys. You have nothing. You finally get to competent where you can play Beethoven exactly as it's written, and then you get to proficient, which, you're adding a little more of your own personality to it, and finally you get to expert. That takes place over a long period of time. The other image that always comes into my mind in here is that you have all these people that can sit in the stands at the baseball game and know all the statistics and the hitter and the pitcher and everything else, but yet they couldn't hit the ball because you have to stand at the plate and have thousands of pitches thrown at you before you can hit the ball. One thing to sit in the stands and talk about it. That's great, and you make a great conversation. You want to be a ball player, you got to stand at the plate, and you've got to take your swings, thousands of swings. And the same thing goes with trading. You have to learn it. You have to stand at the plate. Okay.
Okay. Um, okay, I've had several people ask different questions about candlesticks and bar charts. We use a 30-minute, for the TPOs on our market profile chart. As you heard Jim earlier say, he doesn't
Yep.
use 1, 3, or 5-minute charts or other time
Candlesticks.
frames.
They're
Uh-huh.
price based. They're price based. Um, I have experimented. I found a 30-minute bar chart. A lot of information that I get from the 30-minute bar chart, you will not get from shorter charts.
Okay.
And like I
So,
said, over 40, 50 years, I've looked at this over and over again.
and you're welcome to just try them all different out and observe. I think that can be helpful for beginners, or also to dispel, that maybe you're not really getting good information from 1, 3, and 5-minute bar chart, 1, 3, and 5-minute charts. But it also depends on what kind of trader you are and what kind of trading that you're trying to do.
Well, a lot of
Um,
times when you're using these shorter charts, um, it gets your system so riled up. It gets your system so riled up, and the emotions are so high. Jen, let's replay Friday.
Okay, we have a lot of other questions related to that. I just wanted to mention Jim does not use candlestick charts um, for a number of reasons. And so the answer to that is he does not.
I use
Okay.
only I use only 30-minute bar charts. That's all I use.
Yes, and then somebody else was asking about monkey bars on Toss on Thinkorswim. There's a small handful of clients that really don't want to pay for market profile charts. Or they don't feel that they need them. So if you can make that work for you, that's fine. You do what works for you. We don't feel it has enough of the information that we like to see with regards to how the market's trading. So that's why we don't usually recommend that. Okay. Let me go back to my screen. Okay, Jim.
Okay.
Um, what
Now,
speed do you want to start this off at?
we'll start it off at about 15 times. Okay. Now, remember, I pointed out that one of the uses of options, I know the market's going down on Thursday. I can see it down. Prices hit me in the face all day long. I listen to the TV and that stuff said, well, maybe I'm wrong, but this is where options come in for me, because I'm sitting there and I'm pretty comfortable that the market was Thursday, as we went home Thursday, that the market was short in the hole. Short in the hole means inventory is short at poor prices. So much of short-term and particularly day time frame trading has to do with inventory adjustments. Inventory gets too long, gets too short, gets too long, gets too short. A lot of times people don't realize that, but that's really when if inventory gets too short, that strengthens the market. Why does it strengthen the market? If you're short, what do you have to do to cover your short? You have to buy. So if the market gets too short, that strengthens the market on a short-term basis because you have to buy in order to cover those shorts. Now, once those shorts are covered, it can have the opposite effect. It can weaken a market. Okay, so there's a possibility that as we replay Friday, we got a huge short covering rally on Friday, set up by what happened on Thursday, but that could have actually weakened the market because it removed that support that was developed by the short inventory. Okay, so now when I look at this, yes, I get the same fears that a lot of other people. I see the market's down on Thursday. I think it's short in the hole or short at poor prices, but markets are random and a lot of things can happen overnight. And I've watched them and I'm listening to TV down 10%. It's a real, it's a real correction now. And I also know something else, that the longer time frame, I'm talking about the investment managers that have, trillions of dollars. A lot of times, if they're going to be sellers, they don't become sellers till the market's, off 7 to 10%. Remember, if these longer term investors and made a lot of money by being long for a lot of years, if they got in and out, with these little adjustments in the market, they're not going to have the long-term performance because they make their money by time in the market. But when the market's been off 7 to 10%, that increases the odds that they start to hit the panic button. And I think it was 1980 when the market hit the low following the collapse of Lehman Brothers. The long time frame panicked, and the low was made. I think it was 80 billion contracts on the low that day. That was the low for the market. So the long time frame panicked, but they don't panic every day like you and I do. They wait and they do it in big time. So again, and a lot of times where the market is right now, this is the danger zone when it's down 7 to 10%. If they're going to hit the panic button, a lot of times it happens here because they're starting to get calls from clients and that puts self-doubt in their mind. So I don't know what's going to happen, but that is one thing that was going through my mind. Now, when I look at Thursday, I thought the market was short in the hole. And how do I play that? I play it by buying out of the money options with the possibility of having a short covering rally on Thursday. Okay, let's replay Friday. Okay, so now let's stop for a second. So overnight inventory is 100% long, right? Now remember, if overnight inventory is long and you do not get a counter auction, that is a sign of short-term strength. It only happens 15, 20% of the time. But in this case, overnight inventory is long, and watch to see if you get a counter auction. Continue to play. Play it about 20 times normal speed for right now.
And Jim, just a quick correction. Somebody had, like, I think when you were speaking earlier, because somebody mentioned that you had mentioned um, about that Friday's value was building lower. You inverted it again. You meant to say building higher, just in case anybody was confused by that.
Thursday's value is building lower.
Okay.
Okay, now stop here for a second. There's going to be another piece of information here. You have, I don't read the news. I want to know at what time the news is coming out. Now you have 10 o'clock. You have 10 o'clock news on Friday, and I believe it was consumer confidence. And the news came out, and the news was very negative. Now watch what the market does with that. So you're going to get the knee-jerk reaction, but watch what the market does with that news. Okay, continue to play, please. So no counter auction to overnight inventory. The market's going up towards the 5,600 level. The shorts were being set up on Thursday. That's what we were talking about. There you're at the 5,600 level. The next reference is going to be the overnight high, or I'm sorry, Thursday's high. Okay, go to 30 times speed. Okay, there's the B period. Remember, I told you that the consumer, I think it was consumer confidence. Consumer confidence was negative. That would normally put the market down. You got the knee-jerk selling on the market. So it's adding some. It didn't crush it. They're going to come back here, try it again. Short-term traders are looking at that, say, boy, that's weak. That's weak. That's weak. Keep your eye on value. Keep your eye on what's developing on value. You got a lot of volatility in here. Now, keep in mind the B period. Look where the B period high is. It's exactly at 5,600. So the selling came from an exact level. That is not strong selling, not when it comes from exacting levels. Values building higher. Okay, remember we commented on the B period was weak. It's back. Now it's even weaker because both the B and C period traded there. Good odds for coming back through that. Okay, Jen, play the rest of this out at full speed, please. Okay, now remember we talked about the short trap on Thursday. Now get inside of the head of the shorts. Some covered early, right? But there's the hanger on. They're praying that they're going to be right. They're holding on. They're holding on. They're holding on. And you've got to know that when we talk about, here's another one, tone for the day is up. Understand that the inventory was very short. But again, you have to understand the behavior of the people you're competing against. Some of them are hanging on, and you've all done that. We've all been there. You're praying that, oh, just let me out this time, and I promise I'll never do it again. And this is very important because what you're going to see that in action late in the day. So we're playing at full speed in here. This is a short covering rally. It was set up by what was happening on Thursday. That was just a classic short covering trap. So remember, we're playing this out at full speed, but I want you I want you to get inside the minds of the competition. There's shorts in there. They don't all cover. Someone they're praying for, if you let me out of this, I promise I'll be good. I'll promise I'll do this, blah, blah, blah. That's the little voice in your head say you're going to be okay. The later it gets in the day, it's a weekend. The later it gets in the day, they're caught with the short, the riskier it is that you're going to get this squeeze. Remember, you probably haven't gone enough to cover all the shorts. Now, anybody that's been with us for a period of time, what's a short covering rally look like? The structure of the profile is actually informational. So when you get a short covering rally, very often you get a P-shape formation, a long stem on the bottom, followed by a P shape on the top. What that tells you is you're getting short covering, which is old business, but it's not being healthily joined by new business. A strong rally would be short covering, followed by new money buying. That would elongate the profile. But notice what's happened. Notice the point of control, 6 wide now. See if you can use your imagination and see the P is forming. That's an indication you're getting continued short covering in the market. Those that were short, they're still covering their shorts, but you're not getting joined by new buying. But as you get closer to the close, those shorts that have been covered, guess what they're feeling? They're feeling pretty uncomfortable. And they're making promises to somebody that, get me out of this one, I'll never do it again. Now notice the mechanical nature of the DFG. That's very mechanical buying down there. Look at the P formation. You're seeing we had the short trap on Thursday. Just these shorts, they're trapped. As you're getting late in the day, they keep hoping. They're hoping. Remember, hope is not a strategy. They're getting squeezed late in the day. Can you just feel this? Feel what there's. If you're caught short, feel what you're feeling in here. You're sweating it. You're praying. Oh, I know I'm right. I know I'm right. Oh, please help me out this time. Help me out this time. And every time you're in that position, guess what? The market usually does not accommodate you. See the P formation. It's an indication of short covering, not a combination. A healthier profile would be elongated, more short covering and new money buying. This has got short covering, but it's not giving you good new money buying. Okay, those shorts are getting closer to the, there they go. Those shorts that were hanging on. Okay, so what happened? The shorts were forced to cover, and there was some selling into it. Okay, now as we close Friday, I'm going to call this a spike. Okay, now for Monday, opening below and staying below this spike is negative. Opening and staying within the spike is neutral. Positive would be opening and trading above the spike. Negative would be opening and remaining below the spike. Positive would be opening and remaining above the spike. All right, we're done. I'll take a few questions. I hope this was meaningful for you.
Yeah, and I know this. I noticed that we have a lot of newer folks here who may be confused. And this is not something you just learn overnight or just from a few webinars. You have to learn how to observe like Jim first to really dig down deep with this. Okay, a question from earlier that I think several people would have. Sometimes Jim is now showing SPY the SPY on the daily charts and sometimes the ES. So which one should we use to look at the daily bars?
It doesn't make any difference. The SPY trades off the ES. The reason I use the SPY, I trade this, I'm trading the SPY more and more. And the reason that I've been telling people that I'm trading the SPY is that the slippage, there's so much volume in the SPY that I can always do market orders, almost always do market orders, and the slippage is minimal. The ES is better for people that are trading 100 lots. And it's not very good for people to trade in 5 and 10 lots or 1 lots. The slippage is much greater, but they trade off of each other. I just find that the depth in the SPY and the efficiency of the SPY is very beneficial to me. The difficulty with the SPY is it doesn't trade overnight. So if I have to make an adjustment over the night or make some change to a position, I will use the ES. But I don't think it makes any difference which chart you use. Okay.
Okay. Okay, somebody was asking, if Friday was a short covering rally, does that imply that longer term sellers are still in control and that we're likely heading lower?
I don't know if it means we're likely heading lower, but what it does say is that it was old business short covering. I saw no indication of new money buying on Friday. Remember, so where we are right now, I mean, we're at that, you saw on the bar chart where we are. So now the question is, as you come into next week, do you get downside continuation or, was that the end of it? You're at that 10% level. Now, remember, what do you got in the middle of next week? You got an FOMC meeting, starts on Tuesday with results on Wednesday afternoon. That may be watched fairly closely, but you've got a lot of volatility in the market. You've got a very, very difficult environment. So right now, I would say that think of a trade location. You know where the trading range low is now. So what you want to see is, do you stay within that trading range low, or do you extend to the downside, or do you start to extend upside? So right now, I'm going to call the market balanced. If you take a look, Jen, I'm going back to my bar chart.
Okay, let me give you the screen, Jim. One moment. There you go.
Okay, what I'm looking is right here. 1, 2, 3. I'm looking at a 4-day balance in here. So when I come into next week, if I start to trade above this, that's short-term positive. If I trade down below this, that's negative. Okay, so this is what I'm looking at. I'm looking at a 4-day balance as I come into next week. Remembering that I've got an FOMC meeting announcement on Wednesday. Okay, final couple questions.
Yes, somebody's asking, is this a case of we really needed to rally so that we can continue to break further?
It's a possibility. I mean, sometimes markets get too low, too short to go any lower, and sometimes they get too long to go any higher. So on Thursday, now, if you ask that question on Thursday, I would say, and the reason I went home long calls was I thought the market was too short to go any lower. I thought it was a short trap. Now, it gave the market a chance to balance short-term inventory a little bit more. So right now I'm balanced. What I'm looking at this is balance. And I put the balanced trading guidelines for next week. The balanced trading guidelines are as follows. Remaining within balance means there's nearly no change. Break out to the downside, go with it. Break out to the upside, go with it. Attempt to break out to the downside and fail, fade it. Attempt to break out to the upside and fail, fade it. Okay, those are the balanced trading guidelines. Okay, final question.
Based off of a lot of the questions that I'm seeing here now, I just want to say, yes, this has been recorded. I would definitely review it because we got a lot of questions about, how did you know, like on Friday we would get short covering or just different things related to that. How did you see signs and things like that? So if you didn't join us, if you weren't here from the beginning, you'll want to review this so that you can see the details of all the things that we pointed out that happened on Thursday that gave you clues about, that we were going to have a short covering rally. Okay.
But the real clues were the references on Friday, the exact selling from mechanical references. That is an indication it was shorter term sellers getting themselves in trouble. Okay.
You mean Thursday, Jim?
Thursday.
Yeah.
Selling was from mechanical references. Remember, early in the morning, we have two mechanical references. I think one was a tick below the settle, and I think one was half back from a period. Exacting references, that's usually a sign that it's shorter term laggard sellers. And those are the people who get themselves in trouble.
And then are you using this level here for the spike base?
I'm using this 4-day balance.
Okay, no, but I'm sorry, I'm like looking at the profiles because somebody asked about the spike base, like where we.
Oh, that's the spike base. Hold on, let me go to the profile, Jen.
Okay, 1 second.
I'm basically using. I'll show
Would you use right here?
Yeah, I'm basically going to go from L period above. I'm using that as this. This is the base of the spike. Even though we got rejected here, when I look at the spike it's just a guide. I'm just saying, okay, if we stay below this M period, the top of the spike, that's negative for the market. If we stay within it, that's just neutral. If it's weak, you get below it and you start to extend lower. Okay. Let me say thank you.
You want to take one more question, Jim?
Please.
And I'm sorry we couldn't answer back to everybody. There were just way too many questions, so I had to pick and choose here, and I did respond back to several of you individually as much as I could. Jim, in chapter 14, you described tempo as something learned through experience, noting that dwindling offers and slightly more aggressive bids may signal weak selling pressure. In terms of context, how do you distinguish a genuine shift in control from temporary absorption before another leg down? Does location like a prior day's low or value area extreme impact this interpretation? And how does tempo fit into the broader auction process when assessing true price acceptance versus rotation?
The answer is all of the above. You're looking at trend, you're looking at value. Remember, if the market's going down and tempo gets slow, all that really is an indication at that period of time that the offers are drying up. If market's going up and the tempo is getting slow, it's just an indication that the offers are drying up. It's there's an awful lot of artwork involved in this, and you're not going to learn it quickly. It may take a year. You need to know the concept. And then as you observe, the more you observe, the more the nuances of the importance start to stick out. For example, tempo with the trend versus tempo against the trend may be totally different in there. But you learn that over time with experience. If somebody hasn't taught you to look at tempo and think about it, you're not going to learn it. But there's no simple answer. It just takes time and experience. Let me say thank you very much. I hope you go the book. And believe me, there is so much of the book. I reread the book, and I'm just amazed at how much is in there that I've collected and thought about over my 40, 50 years of trading. My son did a marvelous job of capturing what I was explaining to him. Now, I'm going to leave you with one thought. Sometimes people get really upset when I talk about the difference between implicit and explicit information. Explicit information, like exacting type of things. Most people are too focused on explicit information. The real value sometimes is being able to grasp the implicit information. Too much explicit information is likely to hinder your growth in the market. The explicit mean too much explicit information. You've gathered too many poor highs and, you know, too many moving averages, and you've got all these exacting type of things that, you know, go with explicit information. The implicit information sometimes gets blocked. You don't accept it as it's presented to you because you're so locked up on the explicit. Too much explicit information can really block your understanding of the market's general auction. Thank you very much. Hope to see you all again. Bye now.
Yes, so if you have any questions about joining us for the primer, if you're new, or about any of our other course offerings like the Foundation eCourse or Advanced Nuances, don't hesitate to reach out to us. You can email us at dalton@jimdaltontrading.com or give us a phone call. I'd be happy to speak with you and answer to the best of my ability. So thank you all for joining us for this, what ended up being an extended session on Sunday. We will get the recording posted as soon as we can. It'll be up first on YouTube as soon as it's finished processing. Thank you so much.